Hello, this is Brian Rezny, president of Rezny Wealth Management, bringing you question and answer day. And one of the questions, of course, that we're seeing a lot of, and this is pretty regular, and it's really about risk management and about market volatility. And is there a way to basically curb volatility within the market? One of the things I try to educate every investor about is this. If you have less volatile investments, you will make a lot less money. Investors, unfortunately, are emotional, generally speaking. And most investors do horribly bad on their portfolio because they jump from risk assets to conservative assets, back to risk, back to conservative. They chase what was hot before. They sell what's going down temporarily if there's not a financial reason to sell. A lot of crazy reasons. Look at statistics. Delbar does a study, and they've done it for about 30 years, about investment returns and investor returns, your returns. And investors typically do very lousy because, again, they don't run a strategy. They're short-term thinkers. They're short-term action-oriented. They're jumping in and out when exactly that's the wrong thing, and it's been proven to do that. But it's hard to curb emotions with some investors. Not all, some. Those investors are highly emotional, should basically park their money at a CD at the bank, make 2.5% a year, and call it a day, because you're never going to make any money with your portfolio because you're going to do exactly the wrong thing at the wrong time. The bond market's hugely negative year to date. Look at the treasury market, corporate bonds, down negative, even though the equity market maybe is kind of flattish for the year. So everything has volatility. Everything can go up and down, but remember, look at your short-term goals, look at your long-term goals. Have money set aside for the short-term goals that has lesser volatility within a balanced portfolio. That's how we would do it. And then obviously money for the longer term that's really going to drive the income and the higher return potential of a portfolio. That's how a real money manager manages a portfolio. No emotion, real strategy, which always includes a risk management strategy for the next recession. If you're not a client of my firm, it's time you became a client. If you're looking for real advice, real money management without the sales shenanigans, conflicts, and fines of Wall Street firms, brokerage firms, banks, and insurance companies, with a real fee-only fiduciary money manager, call my firm. There is a difference. It's time you experienced it. Have a safe and profitable day.